TV18's Latha Venkatesh caught up with Mr. Trivedi of Goldman Sachs and started by asking his views on the equity valuations in the global markets.
I think one of the key underlying drivers of the very high equity valuations, I think, are the very, very low level of bond yields globally. And I think the concern that many people have, and that's been fed by some of the recent statements coming out of the ECB board members or from the Bank of Japan, is that you may see some withdrawal of the very high levels of stimulus that has been in place from these central banks, and that if you see some of that withdrawal, that might push bond yields higher, and that key support that has been there for equity markets globally, but in emerging markets as well, and in India as well, that would come off, and that would create some pressure for equity. So I think that lingering concern has always been there, given how low rates are. But that concern, I think, has become a bit more proximate, given the recent action by the BOJ to steepen the curve and the recent statements that we've heard out of some of the board members of the ECB.
Do you think the markets will be able to stomach a Fed hike without too much of dislocation?
You see, I am personally not that worried about the Fed hike itself. I think, one Fed hike every 12 months is something I think that markets broadly should be able to digest. And I think even emerging markets should be able to digest. I mean, I think, and the big reason for that, I think, is that, going back to 2013 when we had the taper tantrum, and the scar tissue of that is with us for a long time, I think relative to that period, emerging market fundamentals are in a much better place. External balances have corrected substantially. The real rate of interest is generally higher than it was at that point. So I think that the fundamentals are in a better place, and we have found in our research that shocks to developed market rates, small shocks, are having less of an impact in emerging markets today than they were at that point in time. So I'm not that concerned about one Fed hike, provided it is coming in a pretty gradual pace and a pretty slow pace, which is what they seem to indicate. I am more concerned about the back end of the curve. I'm much more concerned about the fact that if you see a very sharp back up in long-term rates, that does tend to affect emerging market currencies, that does tend to affect equity valuations much more squarely. And if that happens, you will see more pressure and some degree of volatility that markets will have to digest. But again, I'd go back to what I said earlier. I don't know that you can have a very big increase in back-end rates in some of these core developed markets without tightening financial conditions in them too much. So I don't think the central bankers there. Yeah, I don't think central bankers want to generate a big tightening in financial conditions. I think what is happening is that there is a greater recognition world over of some of the negative side effects of quantitative easing, and I think that is some of these is what they want to temper, rather than engineer a very, very sharp steepening that tightens financial conditions and causes dislocations in markets.